Welcome to Petro's Family Wealth. Today we're going to talk about IRMAA tax brackets and how to reduce them in the year of retirement or with an income reduction. So let's go ahead and dive in. So here's what I'm going to show you is a case where a married couple is on the verge of retirement and they might be in the high income bracket and making about $365,000 a year. And many advisors that might focus just on the tax brackets, where we take a look at, well, you might be in the 24% tax bracket now. And then the first couple of years of retirement, you're in the lower tax brackets. And so how do we make deductions here and then potentially even force taxable events like Roth conversions in your lower tax years to set you up for success in the future? But one of the things that's we find missing typically is a discussion around IRMAA. And what IRMAA is, it's the income brackets that you're in that dictates your Medicare premiums. So similar to our income brackets, where it's a progressive system, the more income you make, the more taxation that you'll have over time. Similar thing in IRMAA. The biggest difference between the two is that if you are $1 over on IRMAA, for what's called the modified adjusted gross income, then you're hit hard 2 years later when those premiums are adjusted. And so let's be very careful and very cautious of it and try to stay away from it as much as possible. But based on that previous made-up example here, if a married couple is making over $340,000 before they retire per year, they can anticipate that 2 years later, their Medicare annual surcharge is going to be about $9,000, $9,240. And that's additional on top of the regular Medicare premium costs. However, for that married couple example that we saw, where they make over $340,000 a year, if they do nothing, then they can anticipate that 2 years later, that the annual surcharge will be about $9,240 more per year compared to the regular Medicare premium costs. But similar to how we anticipate that the income brackets are going to be lower, what we can also anticipate and adjust is the IRMAA brackets. So let's say, for example, where we did it right, where we have multiple different retirement accounts to pull from to meet our clients' needs, both Roth, brokerage, and pre-tax 401ks. Then what we can do is we can withdraw and do Roth conversions as needed up to certain brackets. So if we're able to meet the income needs and withdrawal needs, but have our modified adjusted gross income, so that's basically your adjusted gross income plus any tax-free municipal bond income, any capital gains, things like that. If we can reduce your MAGI to under $200,000 a year, $218,000 a year, then we can actually eliminate this $9,000 a year surcharge for 2 years. But the IRS typically looks in the rear view mirror, so 2 years prior. And so how do we impact or share with the IRS and with Medicare that your income is going to be coming down? And there's actually a form for that. That's the SSA-44. And so in this form, basically what we're trying to do is say, hey, yes, we made a larger amount of income, but since we're retiring, we anticipate that our future income is going to be lower. Therefore, go ahead and reduce our Medicare surcharges. So let's take a look at this form, and you can find it with any Google search. But you basically fill out each form, and if it's a married couple, it's one form per spouse. These brackets here are a couple years old, but you can see here, these are the types of life-changing events that could qualify you for that more proactive reduction of Medicare premiums. And so that could be marriage, divorce, annulment, death of spouse. You see the different list of options here. So typically in retirement, it's either complete work stoppage or reduction of work. But what's not on here is large capital gains. So I get this come across as often when we talk with clients and help them through this form, is that if we sold a cabin or a house and we had a large capital gain, that impacts or increases our MAGI. And then the next year, the following year, the income is going to go back to baseline. That is not a qualifying event for this proactive reduction of Medicare premiums. But you could put your work stoppage, put the date of the life-changing event, and then, and if it's in the past, you can share what you expect for income over this past year. Or if it's a more proactive thing, then you can share what you anticipate your modified adjusted gross income to be in the future. And so with that, you mail that in typically to your local Social Security office, along with any supporting documentation that might be needed. And that way, hopefully, you can save thousands of dollars by being proactive and letting the Medicare know that you should be in the lower modified adjusted gross income brackets. So I hope you found that helpful. Again, SSA 44 and in multiple situations where you can or cannot use it. So I hope you found that helpful. And if you did, please go ahead and like, subscribe, and hit that notification button. Thank you so much.